And Jeffrey Applegate and synthesize this together as best we can. Come on in here and just what are you focused on right now? Is it equity markets and a correction? Is it what's going on in Greece? What within the sphere of what we do with our money should we focus on now?
It's really policy, and by that I mean it's the policy response to what's going on in Greece and what we think is going to work out there, as well as what's going on with U.S. policy, preeminently the Fed, but also more importantly probably what's going to happen with fiscal policy before the first flag that's been sent up by the rating agencies that we need to take some action long-term on deficit reduction.
What is the investment policy that our viewers should have?
The investment policy we believe viewers should have is to be fully invested. If you're sitting in cash, then you're not even protecting your purchasing power. So we think it makes sense to have exposure to credit, broadly defined within bonds. So that could be investment grade, could be high yield. We don't think Treasuries are a great opportunity at this point. Equities, we're also overweight equities, and the primary call we've had there has been really a broad underweight developed markets and overweight emerging markets. That's obviously been a little challenging on a short-term basis.
Fair.
But
you haven't been perfect. That's a Bray exclusive. Jeffrey Applegate has not been perfect. I want to focus here on, I get so many mail from people. Where's a correction? Is it 10%? Do you go by that guideline?
Yeah, I think that's fair enough. Yeah.
Okay, 11,500.
Yeah.
Dreaded first chart. Here it is, the banks. Well, of course, we're not going to comment here on Morgan Stanley. That would be inappropriate. Range bound or rolling over. There's a Keith Bruyette Bank Index. How do you play financials, whether it's U.S. financials or European financials, given your policy challenges?
Yeah, I think the opportunities are probably better in U.S. as compared to European financials, which is related to the European debt situation and some of the holdings that you have for the banking system. So that's a challenge. U.S. financials don't have that. But keep in mind, too, in both places, Europe as well as ultimately here in the U.S., you're going to be facing some central bank tightening. In the meantime, the yield curve is pretty steep, so profitability is okay. But we're not overweight financials at this point. Depending on the portfolio, we're market weight or underweight.
We've been rolling out, Jeffrey, our long-term view. Morgan Stanley Smith Barney, thousands of people you're advising, they've been shell-shocked. Here's a long-term view. We've showed this before. You can see it down here, Jeffrey. 9 decades or so of the Dow. That's a certain flatness. Do you ascribe that flatness on the right side of the screen? Is that just those beleaguered financials, or is there something more there we need to know?
No, I mean, you obviously had two big events. You had the internet bubble, and then you had the global financial crisis. So you had two back-to-back bear markets. And actually, I use that chart with clients, and I say, you know, if you had been in U.S. equities really for the first part of this century, then you aren't a very happy person because you basically lost money in U.S. equities. However, if you'd been in emerging market equities over that same period, your annual average return would have been 8 to 9%.
Pick a bank, or if you'd been in Colgate-Palmolive, do you ascribe index investing at Morgan Stanley Smith Barney, or is it more about active management and that idea of stock picking?
Both. I think there are talented investment managers in both the equity and the fixed income space, locally and globally. And we have an enormous research operation which is focused on trying to pick those good managers. There's also opportunities in security-specific selection. And then there's also opportunity in passive if you want to pay a lower fee and you're willing to settle for index returns. So that's really the client's call.
Let's go to policy, as you mentioned before. Carl Weinberg here. High-frequency economics. The news flow out of Greece is simply remarkable, with the spread at 1,477 basis points. Greek decay, Weinberg way out in front on this debate, as was Joachim Fels of Morgan Stanley. As of this writing, there is not a single idea on the table that the governments, plural, seems likely to converge on. I mean, is it chaos over there? Is it rhetorical and theoretical chaos in Europe?
Yeah, I think there is some convergence, and there's convergence around beginning to come to an agreement on rolling over debt, and that's really the first
and extending
step.
Out the maturities.
Exactly, and that's really the first step you need to make. At some point, and this is not soon, but down the road, Greece needs to restructure, as a lot of Latin American economies in prior cycles had to restructure. That will have to happen, but that's not near term.
You see Euro-Yen, which is a 115 handle, 114.83. And our Maria Petrakis Papandreou said to be told by opposition to quit Greek post. Let's look at the terminal here. This is what I follow, Jeff Applegate. Stronger Swiss franc, a little bit of a bounce up, but you can see this drop down on the news. It's minute by minute. Why should American investors focus on Greece?
The focus on Greece really is around several issues. It's really around currency primarily. If you think about the euro, it's a bit of an odd currency. You've got monetary policy union for the eurozone, but you don't have fiscal union. And so I think you're seeing the beginnings of the very early steps ultimately towards moving towards fiscal union, and that will have a big impact in terms of currency. The way we reflect that in our investment portfolios is we manage global equities.
Right.
We're underweight European equities because most of our clients are U.S. dollar based, and we have a concern that the euro, having gotten up to nearly 150, is now heading the other way, and depending upon how this Greek debt situation works out, and as you can see, it's playing out headline by headline.
You can make 15% on Nestle, but you really wouldn't be making 15%
because you'd lose it on the currency potential.
On the currency potential.
Right.
This was a great interview. Look at this at Tom Keene on Demand. Earlier this morning on Bloomberg Surveillance, I spoke with Marie Duran of Oxford Economics, and I asked her how will Europe get to an efficient recovery within Greece and the periphery.
We are really very doubtful that this can be achieved in Greece. The extent of the reforms to be carried out is really significant. It's also the fact that Greece cannot rely on a depreciation of its currency since it's tied to the euro. And our forecast on the Greek economy will keep very low growth rates for time to come.
And Jeffrey, to take this over to Europe, this is Jens Bastian. This story printed just moments ago out of Athens and Maria Petrakis. When a government has so profoundly misjudged the anger, frustration, and disillusionment in the population, I would extend that over to the United States. There's an angry public out there. How do you invest given that political anger?
Well, I think part of that political anger we expect will be addressed. We are looking for an initiative from the White House, which we think has a good shot at passing Congress next month, to provide, again, payroll tax relief and potentially a targeted jobs tax credit. If you think about the anger in the U.S., it's probably overwhelmingly about the job situation. We're growing jobs in this country, just not as fast as we should. If we can do some things, and there are things the government can do from fiscal policy to improve job creation, we're expecting that to be proposed by the White House next month, and we think it's got a very good shot getting through Congress. So that should help how people feel about the job market.
Stimsterity, Dan Clifton talking up that phrase, the idea of stimulus now and austerity down the road. Is that a legitimate concept?
I think it's absolutely legitimate. I mean, we have a cyclical softness, cyclical slowdown here and elsewhere in the world. So insofar as you can offset that with more stimulative government economic policy, while you also take steps to say, okay, we acknowledge we've got a big out-year deficit problem. We need to make some changes in terms of our structural deficit. You can do both at once, and I think it's appropriate to tie them together.
Here's a chart. We've shown it before, long-term view. Slope matters. It's a log chart on the y-axis there. You look at the slope, you can see the 20s, the buildup of debt into World War II, rather, the quiet, and then the slope up, and then a little bit of quiet 10 years ago. And Jeffrey Applegate, should we care about the debt ceiling? Please tell me. Somehow, you know, we've been through this. Somebody said on Bloomberg View today, 70 times we've been through this ballet.
Actually, 81 times since the Second World War.
I'm going to write that down. 81 times.
Right. So, but we should. Normally, it's a routine event that this passes Congress. Yeah. But because we faced this out-year deficit issue, the only way it's going to clear Congress now is tied to a significant multi-year deficit reduction package. So that's going to be important for the markets. And if you look on a very long-term basis, there is a relationship between the deficit share of GDP in the U.S. and the price-earnings multiple on the S&P 500. If the deficit share of GDP is going down, chances are, usually historically, the price-earnings multiple is going up. As you know, the multiple on U.S. equities is very, very low. It's below 12 on forward earnings.
Alan Meltzer riding up a storm. He's become very controversial, the professor at Carnegie Mellon. Here's the op-ed in the Wall Street Journal today. Strong language from Alan Meltzer. A welfare state or a startup nation, after one generation, a 1 percentage point difference in growth rate becomes a 25% difference in per capita income. Low growth significantly lowers real wages. He's saying get to it. Mm-hmm. Which do you get to? If you're the president, forget about investment. Which do you get to first? That job challenge or the fiscal deficit?
Well, if you Getting to the job challenge first will help you on the fiscal deficit because you'll improve growth, you'll improve tax receipts, you'll improve revenues. So that is also deficit. Stimulus is also deficit reducing, not on an immediate basis.
Tea Party viewers just fell off their chairs.
Well, but it still is. But that only deals with the cyclical portion of the deficit. Then you have the structural portion of the deficit,
right.
And that's really entitlements, Medicare, Medicaid, Social Security. So you need to make changes there. If you look at the last big change we made in entitlements was in the early 80s, we raised the retirement age. Well, here we are now, 30 years later. People are living longer.
Why is this a debate?
Well, it shouldn't be. It is, because it's politically sensitive. But I think we're setting the stage for ultimately getting there, either
right.
Maybe probably not before the 2012 election, but I think inevitably after.
Chart 2, bring this back to investment. So here we are. We've got X amount of dollars, less than we had 4 years ago. For many of us, from Jason Trennert and Strategic Research, here's a chart, Jeffrey. Does market cap matter? Okay, I'm going to suggest the line's barely moved. The line up is a better NASDAQ 100, thank you, Apple, versus the S&P. Is it an early 60s Nifty 50 age, or is that just a distraction from what we should do with our retirement assets?
No, I don't think there's any perfect historical analogy to the period we're in now. The period we're in now is much more global than any other period. And so coming back again in terms of, think about why do you own equities? You own equities to have a call on growth. Where's the best growth on the planet? Emerging markets. That's why it's been that way for some time. We think it's going to continue to be that way for the balance of this business cycle. And that's why we've been so overweight emerging markets.
Do you, and I think of Margie Patel at Wells Fargo, Wells Capital Management rather, or Bill Gross at PIMCO, I got bond people saying buy stocks. Right. Not that that's a first, but that's a rare occurrence.
Indeed.
That you got bond buys. Guys, Jim Caron maybe at Morgan Stanley would say the same thing with a higher rate regime call. Does that put all your radar up about equities when the bond teams on board the equity call?
No, not necessarily. We will get concerned when it becomes overwhelmingly consensus, and when sentiments gets too ebullient. We're not close to that. Matter of fact, we're far from that.
11,926. We're not near a correction yet. We're like 400 points away or so.
Just about.
Yeah.
U.S. equities are about 6% off their peaks of late April. So if the average matters, then we've got more to go.
Good. I'll go watch Spider-Man instead, something more interesting. Jeffrey Applegate, thank you so much with Morgan Stanley Smith Barney.